So it's wonderful to be back here at Real Vision and to talk about the Tripolar World. I had a great interview a year and a half ago with Grant Williams, and so happy to come back and update the audience on what's happening in the Tripolar World framework. So as a quick review, the Tripolar World really stands for a thesis which argues that regional deepening and regional integration in the three main regions of Europe, Asia, and the Americas can drive the global economy forward. And it's an outgrowth of my frustration, really, for the policy mix that was developed over the course of the years following the great financial crisis, when policy really was central bank driven and monetary policy specific, which worked out well for the financial markets, but didn't help Main Street in the real economy particularly very much. And so as a result, one of the results is that we've seen this rise of populism, both in the developed and the emerging economies, which we now have to deal with. So as a reminder, the Tripolar World regional integration is driven by three new and mutually reinforcing factors. The first is each region's growing ability to self-finance. So if you think about the development, for example, of the Chinese capital markets, or South American pension system, or the European corporate bond market. All those are examples of each region's growing ability to self-finance. The second driver is each region's growing ability to self-produce. Think about advanced manufacturing, robotics, 3D printing. All these things are allowing production to be centered closer to the consumer. And so the third driver is exactly that. Each region's growing ability to self-consume, driven really by the rise of urbanization, service sector economy, and of course, e-commerce. So as we see it at TPW Investment Management, globalization as it was discussed and described in the 1990s and early 2000s is no longer viable, certainly not at the ballot box, whether it's in the United States, Europe, really anywhere in the world. And secondly, economic nationalism really doesn't work in our global economy. So we believe that the Tripolar World is a kind of interim step, or a step in between the two, between full globalization and economic nationalism. There's space for regional deepening and regional integration to drive the global economy forward. And from an investments perspective, we believe that it offers our clients and ourselves a differentiated view, a different way of viewing the markets, economics, politics, which therefore should allow us to generate alpha over time by identifying things and looking at things through somewhat of a different lens. So the Tripolar World framework is really something that I've been developing over the last half dozen or so years. Really wrote my first piece on it back in 2012, 2013. And so it's constantly been evolving. And some of the really early opportunities in terms of an investment opportunity as viewed through the Tripolar World framework was with the Brexit situation in Europe. When Brexit happened, everyone was very bearish on the euro and on Europe. In fact, it turned out to be a great opportunity because it really forced Europe to start to think about how does it integrate more deeply. And then with President Trump's election, you had NAFTA and the threats to break up NAFTA. And if you remember, the Mexican peso went from 18 to 22, tremendous opportunity to buy the peso, because if you had that regional deepening perspective, you realize there was no way we were going to move to break apart all those regional supply chains that have been developed over the last 20 years. And lo and behold, here we are with a new NAFTA, the USMCA, US Mexico-Canada agreement, which effectively is the same agreement with some minor touches. The one change that is significant and was buried in the fine print is that any of the three parties who want to enter into a trade agreement with a non-market economy has to let the other two know. So no prizes as to who the non-market economy is in this situation, obviously China. So as we think about the Tripolar World today, we're really focused on two separate themes. The first is what we call the three T's, for trade, tech, and turbines. And the second is what we see as the American divergence shifting to rest of the world convergence. And we'll talk about that in a minute. But first, the three T's. So when we think about trade and the conflict between the US and kind of the rest of the world, at least initially, now kind of settling in to be a US-China focus, there were two things that stood out to us. The first was that President Trump clearly wants to bring some of those supply chains closer to home and within the United States. And to us, that's really pushing on an open door, because if you think about the second driver to the tripolar world, it's each region's growing ability to self-produce. And so that is in fact happening. It's called reshoring. It's been going on for some time, but the president is trying to drive that process more aggressively. The second thing that stands out in terms of the trade is it's really directed against China. And this has become clearer over the last several weeks. And to us, it suggests actually an interesting driver to Asian integration. So the typical perspective is, oh, the US is challenging China's capacity to export to the United States, and we want to shrink that trade deficit with China. The way the tripolar world thinks about it, when you look at the prism or the framework of the tripolar world, is that we're actually driving Asian integration by forcing China to do several things. First, we're telling them that they shouldn't rely on the US export market. Second, we're telling them that they shouldn't rely on US semiconductors and technology and things of that nature. So what are we hearing from China? Now we hear about China's need for self-reliance. We hear about production shifting from China to other parts of Asia, driving that Asian integration that is a central thesis of the tripolar world. So when we look at the trade fight and all the headlines that are written about trade, we think about it in the construct of deepening Asian integration and really ceding Asia almost to China. And when we think about the strategic implications of that, it's quite concerning, because when you look at global growth forecasts for the next 20 or 30 years, the vast majority of global growth is expected to come in Asia. So by the US stepping away from TPP, forcing China to become more self-reliant, driving the dispersion of production and capital away from China to India and the Southeast Asian nations, all of that is driving Asian integration and making it a more challenging situation for the United States. So that's trade. The second focus on our 3 Ts is tech. And here, tech is really fascinating, because technology, first of all, from a market perspective, has been the principal driver to the US outperformance this year. In 2018, it's been basically the US outperforming everything else, and that outperformance driven by technology. But over the last several months, technology has really started to suffer and to flag as a performer. And I think, in our view, it's the tech space is sniffing out the fact that tech is most exposed to this trade conflict. And here's why. Tech has basically been valued as a global opportunity, right? Global, it can benefit from supply chains all around the world in terms of production, for example, of smartphones. Pieces come from all over the world. They're assembled in China. They're shipped all over the world. The demand is global. Smartphone demand in India, smartphone demand in Southeast Asia, smartphone demand in China. All of that is underpinning the valuation of tech stocks. But what we have today is actually a splintering of the technology space. And you have such tech luminaries as Eric Schmidt, former chairman of Google, saying that in the next decade, he expects there to be 2 internets, one driven by China, one controlled by the United States. And there's even a new term for it called Splinternet, which is kind of interesting. I hadn't heard of that until quite recently. But I think that is a real factor for investors to consider. If we are in fact going to a kind of a regional tech universe where technology has a US kind of space to it, a Asian, China-specific space to it, and then a European space to it. And Europe's very important here because Europe is really the regulator. Much as in both in trade and technology, Europe is very important because it's the swing player between China and the United States. And so Europe actually has quite an interesting opportunity to kind of play one off the other. But in the trade space, it's Europe ruling through the WTO. In the tech space, it's Europe ruling through privacy matters. So you have tech, which has been valued as a global play, now having to be looked at, I think, much more as a regional play and subject to very different supply chain constraints and very different demand profiles. And I think this is going to play out over the next coming years, and is something investors really need to start to think about deeply. And again, the tripolar world gives us an advantage in how we view this because we can see it through that regional integration process. And then the third T is turbines. And I don't mean turbines as in energy and power, turbines as in kind of the honorific headwear that different ayatollahs wear, for example, in Iran. And what I'm really driving at here is sanctions, and the US sanctioning different parties, trying to limit them to participate in the world economy, and the potential blowback to the United States of that policy decision. And it really struck me a few weeks ago in the UN meeting here in New York when we had Europe, China, Russia, and Iran all working together to develop an alternative payment system to avoid US sanctions on Iran, keep Iran in the nuclear agreement, and basically set up a different financial system and financial structure. Now, many people say that's kind of ridiculous and it's never going to happen, and it probably isn't going to happen in the near term. But I think it's important for investors to really contemplate a couple of things. One is that the US is among the world's largest debtors. Two, the US in the next couple of years is going to have trillion-dollar deficits. And three, we need foreign buyers to purchase that debt. Otherwise, we have to make it more appealing to them. And how do we do that? Well, we either have to make the interest rate higher or the dollar cheaper. And neither of those are particularly in the mindset of investors at the moment. And certainly in the US equity market, if we've just seen the last few weeks, higher interest rates are not conducive to equity market appreciation. So I think when we look at the tripolar world, what we see is that a lot of the current activities, be it trade, be it tech, be it US economic sanctions and financial sanctions, are all accelerating the development of the tripolar world. It's accelerating Asian integration by forcing China to be more self-reliant and to distribute low cost and low production value material to Southeast Asia. It's driving technology into separate components. And we haven't even talked about the coming fight over AI, which is going to be very much a China-US fight. And the people who know way better than I suggest that whoever controls and dominates the AI space is going to have a very significant leg up. And then you have all the issues surrounding the supply side of, are there Chinese spies putting little pieces of equipment on motherboards, which then go into the US system and they can spy on us? All you have to do is think about that for 5 minutes and you realize that a global supply chain in technology, which has really underpinned the pricing of the hardware, is going to have to change. And then that demand. We're not really allowing Chinese companies to do more in the tech space in the United States. Is it going to be any surprise when in the next few years it's quite likely that US tech companies, already limited in China, will become even more so? And then finally, the sanctions, financial sanctions, we think are a very, very big issue. The US is going to require a lot of buying capacity to buy the the debt to fund a $1 trillion budget deficit on an ongoing basis, to suggest to foreign buyers that, you know what, you shouldn't really want to participate in our financial system. You shouldn't want to have dollar-based commodities. Is it any surprise that China is now trying to develop yuan-denominated oil contracts and other contracts for commodities? So as we look at the world, we think the US is setting up for some potential problems with its policy mix, which drives that regional integration, the process that underpins the tripolar world. And we believe we'll have opportunities that we potentially will see before others, given how we approach the tripolar world. So as we think about the world going forward, one of the key themes that we're looking at is this idea of the sustainability of US divergence from the rest of the world. And we're doing this through not only the tripolar world framework of regional integration, but also using our next level down analysis, which we call the Global Risk Nexus scoring system, or the GRN. And the Global Risk Nexus scoring system allows us to score, to actually rank each region and the world in 4 separate factors. economics, politics, policy, and markets. And we see this as really allowing us to quickly identify areas of disagreement within the team, areas of opportunity that we perhaps haven't thought about, how different views shift and shape over time. So we actually go back and look in history. How did we value America's trade policy, for example, over the last year? How has that evolved? How do we view European economics, for example, over the last year? And each one of those four has subcategories that we also score on a monthly basis. Our process is primarily a monthly portfolio asset allocation process. So as we look at the world today, what we've noticed is that we are, in our view, just passing through peak divergence between the US and the rest of the world. And let's go through each one of those four to identify how we're moving and how we see that particular process moving. So in economics, if you think about the US in Q2, 4% plus GDP growth. If you look at the rest of the world, China decelerating, Japan still not growing particularly rapidly, and Europe being quite disappointing in its growth. So that divergence between US growth and the rest of the world's growth was quite significant. We believe going forward that divergence is going to narrow. And so, for example, if you look at 2019 consensus GDP forecasts, by Q4 of 2019, the US is only forecast to grow 2%. So we're talking about 4% plus in Q2 of 18 to 2% growth in Q4 19. So that is converging closer to the rest of the world. So that's economics. The second is politics. Politics has clearly been an issue, particularly in Europe. When we think about the European integration, the European pole, politics has bedeviled the European financial markets, whether it's from Brexit all the way through to German coalition problems, to Spain, Catalan separation from Spain, to Italy, to Turkey. It's just been one thing after the other. And the US, for all of its kind of political intrigue within the White House and between Congress and the White House, really hasn't had any effect on US assets, as obviously is clear because the US has done so well. I think that's in process of changing as well. When you look at President Trump's recent comments about the Fed, we think that really that spooked the market a little bit. And while we have no expectations that the Fed will remain anything but independent, that kind of talk, again, from a very large debtor, is not conducive to market stability. So we think that political kind of Teflon nature of the US is going to converge with the rest of the world. And the other side of it is that the European political risk would have to seem to be pretty fully in the price of assets, be it equities or the euro, for example. So that's economics, that's politics. If we think about policy and focus on the central banks for a minute, we have the Fed tightening, raising rates now 8-9 times in a row, in the ECB, for example, and BOJ doing absolutely nothing. And as we go forward, we're of the view that the Fed is likely to pause here over the next couple of quarters, while we do expect the ECB to end its QE at the end of the year, as has been suggested for some time, and look to raise rates in 2019. So that divergence is also narrowing. So we're going from a period of kind of US exceptionalism, US divergence from the rest of the world to convergence. And then fourth and finally, and most importantly, obviously, since we're investors, is the markets. And here, it's really fascinating, at least to me, because you've had a situation where the US has been kind of turbocharged on its economy from fiscal stimulus, and that turbocharging has also turbocharged earnings. So you have a situation where US earnings growth in 2018 more than double the non-US developed markets average, for example. And that earnings growth in the US has been led primarily by technology. So here we are right now in the middle of Q3 earnings season. People very focused not only on the Q3 earnings, because that's backward looking, markets are forward looking, very much focused on Q4, and more importantly even than Q4, 2019. And so if you look into 2019, two things really stand out on the earnings front, which I think, and we think at TPWIM, is very, very important for investors to consider. The first is that technology goes from being an above average earnings grower in 2018 to a market level earnings grower in 2019. So tech earnings, which have been way ahead of the market, are going to basically coincide with the S&P, okay? That's one very important factor since tech has been the leading sector year to date for the US equity market. The second, even more important from an asset allocation perspective, thinking globally, thinking about the three regions, Europe, Asia, and the Americas, is that US earnings growth is going to converge with the rest of the world earnings growth. So if you look at 2019 forecasts, Europe is forecast to grow earnings roughly 10%, Japan 8%, in the US 10, 11%. So all of a sudden you have a situation where those drivers which have led to that US outperformance over the course of 2018 are all starting to converge with the rest of the world. And that to us really suggests that investors need to consider a different kind of playbook as we go into late 2018 and into 2019. It's really fascinating. We finished up talking about that American divergence converging with the rest of the world, and it's actually apparent in the performance of markets. So if you look, for example, year to date, the US is outperforming the ACWI ex-US markets by 1,500 basis points. It's a massive gap, ahistorical in its size, not a usual performance. The last 3 months, that gap has shrunk to 600 basis points. And over the last 1 month, it's 100 basis points. So that convergence of all the things we talked about has also happened in terms of equity market performance. And I think investors have to be careful not to be kind of, not seduced, because that's the wrong word, but frightened away from non-US assets because of all the headlines. So the headlines would tell you, oh my God, you just want to stay away from everything outside the US. The markets are telling you that actually the price to be paid in terms of underperformance for holding non-US assets is shrinking, and therefore potentially going to go the other way. The other thing that's really of interest to us, and I like to look at performance. I like to not try to tell the market what to do, because that's very frustrating, but to let the market tell me what's going on. And when I look at the performance of different assets, because as you know, we're a multi-asset ETF-based investment management company, when I look at across assets over the last several months, several things pop out at me that are interesting. The first is that emerging market debt is outperforming. So for all the talk of the last 6 months about Brazil and Turkey and Indonesia and India and Argentina, emerging market debt, both local currency and dollar denominated, is trying to find a bottom. And that makes sense because they were the first in, and it's typical the first in sometimes can be the first out. So that's something to pay attention to. Within the emerging market space, our positioning is much more in the debt side than on the equity, in large part because we're not really sure what that 2019 equity earnings profile is going to look like, given all the macro uncertainty. So that's one. The second is that gold has outperformed after being a pretty miserable asset to hold for quite some time. And that suggests two things. Well, it suggests one thing, which is that there's real fear starting to bubble, which is a good sign, a contrary indicator, right? Contrarian indicator. People are afraid, that's good, because that means positioning is probably a lot cleaner across assets than it has been. But I also wonder if gold is not sniffing out a Fed pause, right? Because when rates go up, that's bad for gold because it doesn't yield anything. And all of a sudden cash now yielding 2% in the United States, typically you would think gold would be going down, and it has underperformed. But over the last several months, gold has been a significant outperformer, in gold miners in particular. So I think that's something to really start to contemplate as well. And then the third, and probably most important, is that US high yield has outperformed. And this is definitely something that most people would not expect. And high yield has been one of the most hated assets all year. No one can understand how it's performing well. The spread over treasuries is so narrow, et cetera, et cetera. But to me, what that suggests is that recession risk in the United States is not very high, because credit typically leads you into that situation. When credit starts to deteriorate, that's when you typically get a sense that recession could be coming. And the fact that U.S. high yield has done quite well and outperformed on a relative basis is suggesting to us, at least, that recession risk in the United States is not that significant, which then in turn suggests that the kind of equity market volatility we're experiencing currently is more of a correction than the prelude to a collapse or a crash a la 2008. So that suggests that investors probably shouldn't be shaken out, but in our view, the opportunity lies in the non-US markets, particularly developed non-US equity markets, Japan and Europe. The opportunity in emerging markets is more on the fixed income side than the equity side. And the opportunity in the fixed income space is more on the credit side than on the sovereign side. And I think if investors can think about those different prospects, can contemplate a world where trade, technology, US sanctions, all the things that are in the headlines are driving us to a world of regional deepening, regional integration, a tripolar world between the Americas, Asia, and Europe, then you can start to think about, how do I position a portfolio that allows me to take those opportunities that are existing in these different regions. And I think one last thing I'd say is that on the technology side, China tech has corrected almost 3 times more than US tech, but has a much faster growth profile. And so China, it's interesting, a lot of negative press about China. We talked about it earlier, about the trade and the sanctions. We see it as a benefit to China on the medium term and longer term. We're actually forcing China to become stronger by isolating them, as we're trying to do. And I think technology-wise, if you think about China tech, really being able to control all of China and most likely all of Southeast Asia as well, because there really are no tech competitors in Southeast Asia, then you can start to think about, wow, that's an asset that's down 30% year to date. And maybe actually, if we're thinking about technology and we're thinking about a tripolar world, we might want to think about technology in China. TPW Investment Management is a relatively new investment management company. We began earlier this year, and really we offer global, multi-asset, liquid, and low-cost ETF-based portfolio solutions for both individual and institutional investors. At the moment, we have a product suite of 3 different portfolio solutions. The first is our flagship global macro multi-asset portfolio, which has an 8-year track record. The second is a global macro income portfolio, which is fixed income focused, but we add in things like MLPs and equity dividend plays and preferreds into that mix, so it's not your straight, Barclays Ag fixed income vehicle. And the third is a global macro equity product solution, which looks at equities all around the world. All ETF based. And we use macro and global macro in each of our product names because we really want to take back that term global macro, because it's kind of been used as a way to describe a particular strategy, which is global macro hedge fund. But if you actually look into the literature, global macro means focusing and strategizing across national and international thematic ideas. And that's really what we think we do at TPW Investment Management. And so our focus really is to leverage that tripolar world framework, which is unique to us. It's original thinking, and that's one of the things that we like to think we offer, is we are original, independent thinkers in the markets, and that's my background with a lot of experience on the sell side at Morgan Stanley. So we have that mentality of coming up with our own ideas. So we want to leverage the tripolar world framework, leverage our global risk nexus scoring system to create differentiated frameworks and perspectives which allow us to add alpha for our clients.